So then I looked at the debt structure of the United States and realized every single man, woman, child, corporation, and the government, and every government around the world, and every corporation reset all interest rates to zero in 2009. It was like a reset. And everybody's got roughly 3 to 5 year debts, and they keep rolling every 3.5 years. So then I thought, I wonder how the interest payments look. And what I found is the interest payments that the US makes, and the EU, and Japan, and the UK were explained by the amount of quantitative easing that happens 3.5 years later. I'm like, holy shit.
In a constantly shifting and unpredictable economic landscape, understanding the driving forces becomes imperative. With decades of experience, Raoul provides a distinctive perspective on how demographic shifts, debt accumulation, and central bank policies are shaping our financial future. Pal highlights the substantial impact of demographic changes, particularly the aging population, on global economic trends. This shift has resulted in a decline in GDP growth, necessitating an increase in debt growth. The World Bank's 2023 International Debt Report supports this observation, revealing that developing countries spent a record $443.20 billion amid surging global interest rates, underscoring the escalating burden of debt, especially in poorer nations. Pal delves into the role of central banks in influencing asset prices, particularly through quantitative easing. He argues that QE has fundamentally altered the landscape of asset prices, creating a situation where traditional macroeconomic indicators are less relevant. This perspective aligns with CNN's earlier reporting, noting that quantitative tightening by major central banks is expected to withdraw $2 trillion in liquidity from the financial system over the next 2 years.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
This substantial fund withdrawal could have profound implications for global markets.
And in 2008, we just hit the ceiling. Just the whole thing blew up. And it was the defining moment of our lifetimes. What had happened is governments around the world had got to roughly 100% of GDP in debt. Now, if you think about that magic formula, that GDP, the GDP growth, is really what drives savings and investments and also pays the interest on the debt. Now, because GDP growth had been falling over the last 30 years, what you found is trend rate of GDP since about the early 2000s had fallen to about 2%. And interest rates were about 2%. Well, they were a bit higher beforehand. 2007, they were 6%. So what happened is there's not enough money to pay the interest. Because if you think about it, GDP is growing at 2%. You need to pay 100%. You need to pay 6% interest rates on the government debt, which is 100%. But the private sector's 100 and something percent in debt as well. So what happened is the whole system broke. The answer to that was firstly cut rates to zero everywhere. And then it was quantitative easing. And it took me a very long time to understand what the hell this was all about. We kind of knew that they were injecting money into the system. What did it mean? How did it work? Nobody knew. We were arguing about it for a very long time. And it was only until really at about 2020 when we saw the next big wave of... So we had QE in obviously 2009, 10, 11, 12. Then again, I think it was in 14, and then again in 2019, and then a lot more in 2020. And it was observable that asset prices moved every time it happened. And the correlation was very tight. And we were kind of trying to figure out, was this causation, correlation? None of us really knew, but we could observe it. 2020 comes along and it becomes strikingly obvious that there's a bigger force at play here. And I started to realize the force at play here was actually debasement of currency. So people have been expecting quantitative easing to be a inflationary process, i.e. the cost of goods rise, but they don't. The cost of assets rose because scarce supply things, assets, get readjusted in price when you lower the purchasing power of a currency. Now here it's not the dollar versus the euro versus the yen. We're talking basically all fiat currency. The value of it, because there's a lot more of it around, becomes less. And the quantitative easing was the supercharging of this process. So that was basically was the defining factor of asset prices. And if you back it out, and we look at Global Macro Investor, my research service, we look at the G5 central bank balance sheets plus M2 for those countries, and we find there's a 97.5% correlation between the S&P and that. It's like, okay. So what we're doing is debasing currency. So I dug into that and thought, okay, if that's the basis of the problem we now face, let's look at things in those terms. So I started dividing the S&P by the Fed balance sheet or the G4 central bank balance sheets and all assets. And what you got was kind of a normalized world where the S&P had gone nowhere, really. Gold had gone nowhere. Real estate had gone nowhere. But two assets had gone up a lot. And one was technology and the other was crypto. I was like, That's when I started to understand network effects and understand the secular trends that drive cryptocurrencies and many technologies. And that was the whole thesis I started building about Metcalfe's law and understanding that. Out of that whole moment as well, I started focusing on the technology side of the equation. I'm like, why? Because I'm a macro guy. We're generally technology cynics. Our job is like, nothing is new. We've seen this all before. It's all a bubble, right? That's the general macro thinking. And I could see clearly when I looked at the data long enough and divided by the balance sheet and looked at it in various ways that there was something actually much bigger going on.
Powell's insights find additional support in a Fortune article that explores how economists and central bankers are reassessing the impact of quantitative easing on inflation and market distortions. The aggressive monetary tightening campaign over the past 4 decades has prompted a reevaluation of these policies, signaling a clear shift into a new era of economic management where conventional rules no longer apply in the same manner. The ongoing policy scrutiny revolves around 3 key debates: the extent of flexibility central banks can allow in achieving their inflation targets, the efficacy of asset purchases in the policy mix, and the advantages of monetary and fiscal coordination. Let's proceed with the video as Raoul continues to impart his insights.
Global central banks have probably agreed together in 2009, 10, 11, 12, probably 2012 after Europe blew up, that with governments at 100% of GDP in debt, they were going to crowd out all the private sector and we were just going to keep having financial crises. And the only way of solving this was putting it on the central bank balance sheet because there's not enough GDP to pay the interest. So if you think about GDP growth, and let's make the maths easy, even though GDP growth is actually 1.75% trend rate in the US, but let's call it 2%. And let's assume interest rates are 2%, which is roughly where they've been since 2008. So if the government's 100% of GDP in debt, GDP grows at 2%, and interest payments are 2%, that's all of GDP growth just to pay the US government debt, just to pay the interest on the debt. So, but the private sector, excluding the financial sector, so households and corporations, are another 120% of GDP in debt. Well, that will give you negative growth every year of 2%, and it just compounds. So what happens is those interest payments just go into the Fed balance sheet and they monetize it. So then the private sector is not competing with the government. And that was provable across all of the major economies. It's like they've all decided that they were too far in debt and the only way of doing this was quantitative easing. And then I started thinking, well, if I know this to be true, and I know that the central bank balance sheets are 97% correlated with the asset prices, well, all I need to do is use forward-looking indicators for the central bank balance sheets or interest payments. I can back it out a number of ways. And what I found is that I could build a model with Julian Bittel, who works with me, to forecast out the growth of the central bank balance sheet by about 18 months to 2 years. And it works almost perfectly. And then I backed it out a number of ways because I don't want to just rely on one indicator like, forward-looking indicators. I had been using for a long time the chart of the labor force participation rate in the United States, which is a function of demographics. And I found that it perfectly correlates with the Fed balance sheet. And it predicts it going forwards because you know where demographics are going to go going forwards. And it got to this number where the balance sheet gets between 12 and 14 trillion by the end of 2025. Now, if I know that, and I can prove it out by the interest payments that we know are due, because we can see that in advance, and they come to roughly the same number, which is 12 to 14 trillion. Then I looked at it different ways. I looked at the trend rate in a log channel, and it would give you the same number at the same period of time, which is the next cyclical peak in the ISM. If we look at that, and we know that it's the main driver of asset prices, we know where asset prices are going, which is why it becomes the everything code. Because there is no macro. It is all an interest rate cycle driven by interest payments because all debt got reset, which is why everybody has struggled since 2008 to understand the world. Why does technology stocks keep getting expensive? Why does growth stocks? So then I started thinking about that, and I had a hunch that P ratios rising were not a function of crazy people and valuations. It was just a function of the same money illusion metrics of debasement. And what I found is the PE ratios are basically driven by two things. The price, the P, goes up because of debasement. And the E, earnings, are driven by M2. So that relationship between M2 and the balance sheet almost entirely explains P ratios. I'm like, fuck, everything has become a monetary phenomena. Everything. That's why value investing hasn't worked. That's why none of this has worked. It's because we're not driven by the same things any longer.
U.S. stock futures are positioned for a slightly higher opening, accompanied by a stable dollar, as the week kicks off with a Bank of Japan policy announcement and a critical U.S. inflation reading. Simultaneously, Iranian-backed Houthi militants intensify their attacks on vessels in the Red Sea, leading to increased shares in major shipping companies, particularly in Europe. The market speculates that these companies may raise their rates in response to heightened risks. Oil prices have responded by rising, with Brent reaching $77.40 a barrel and U.S. crude climbing to $71.86 by 12:30 Greenwich Mean Time due to concerns about potential disruptions in the oil supply. The upcoming Bank of Japan policy decision is anticipated as a pivotal event in Asia this week, with economists favoring April for the commencement of scrapping negative rates. However, a potential policy shift in December is considered early, and investors are closely monitoring any indications or language suggesting a sooner policy change, particularly related to service wages and inflation. In the United States, attention turns to the Core Personal Consumption Expenditure Index, forecasted to rise 0.2% in November, with the annual inflation rate expected to slow to 3.4%, its lowest since mid-2021. Analysts suggest the balance of risk leans toward a downside, and a 0.1% rise for the month would see the 6-month annualized pace of inflation slow to 2.1%, close to the Federal Reserve's target of 2%. Market expectations reflect a belief that the Fed will need to ease policy to prevent real rates from rising, with speculation of early and aggressive action. New York Fed President John Williams attempted to temper these expectations, stating on Friday that there was no discussion of easing among policymakers. However, market reactions have been muted, signaling ongoing adjustments and rising tensions as the year draws to a close. Share your thoughts on whether the Fed's target has any hope of being met by the year-end, and let us know your reasons in the comments below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.